With BIS Commodities, just taking a look at the markets in review for the week. Let's start out by just seeing where we closed this week. Let's start with corn. The March contract closed down 13 cents at 387. December corn closed 6 cents lower this week at 414. Actually just shy of 415. March soybeans took a beating this week, down 61 cents at 991 3/4. November beans down 44 cents, 975. Both closed below $10 there. That $10 area looked as a support area, at least a psychological support area. Wheat down 31 cents on the week at $5.32. Cattle looks to close about just shy of $5.50 lower in the week. 154.45 looks to be the settlement price. Hogs down 4.50 on the week, 74.50. So a very tough week in the ag commodities. Taking a look at the energies, oil did make new lows this week. Lower lows, lower highs on the weekly charts. A little bit of a rally here the last couple days, set to close. It's probably going to close fairly close to unchanged on the week, but everything is still feeling very heavy in the energy market at this time. Another thing this week, newsworthy item, is the dollar, the U.S. dollar, propelled to 11-year highs, up above 93.50. Some of that is propelled by the weakness in the euro and the things going on with the Swiss franc this week, unpegging their currency against the euro ahead of some ECB meetings next week. The big thing in the ag markets this week was our monthly supply and demand and our quarterly stocks report. It's one of the more anticipated reports of the month, where we tie in our final crop production numbers against a snapshot of how much corn is out there and how do we balance that against demand. We'll start out by just taking a look what it had to say in the corn. I guess the trade was looking for a reduction, or at least there was some in the trade that was looking for a reduction of acres due to the FSA acres. That did not follow through or come through from the USDA. We left our acres alone, harvested acres alone, at 83.1 million acres. But the bullish surprise was the reduction in the yield per acre. We did drop down to 171. That was about a 2.4 bushel an acre reduction from the November report. So that came as somewhat of a surprise, and it allowed us to drop our production numbers down almost 200 million bushels an acre. So the initial reaction to the report was bullish on Monday, because our stocks number came in less than they anticipated. Our stocks number came in at just under 1.9 million, down 120 million from last month's 2 billion, or right under 2 billion bushel carryout, and we found some support on that. And some of that support was found maybe because, well, it was obvious because of the stocks number being, the carryout number being down, But as we decreased that production, we did offset it on the demand side. We did reduce the feed residual number 100 million bushels, and we did increase ethanol 25 million. So the initial reaction and everything was bullish. Maybe the bearish reaction for the balance of the week had to do with the stocks number, which came in stronger than expected. With the trade was looking at a 7% increase in stocks. So the question moving forward is the demand not as strong as we think out there? Or does it suggest that we are not going to see an increase in demand the balance of the year? Can demand go down? And or is the production number really that big? Or was the production number bigger last year? So those are things to keep in the back of our mind as we move forward. Also, there'll be some ongoing discussions this week about and following weeks about having to buy acres. I would say on report day we probably bought a few corn acres with the reduction in beans being as severe as it was. Probably bought a few corn acres that way. Also, Informa was out this week and gave us their estimate of corn acres. They're still down at 88 million, actually up to around 88.7, about 600,000 more acres. That's compared to this last year at of our harvested acres around 92 million acres. So something to keep an eye on in the following months, not weeks to come. Taking a look at soybeans. The soybean number initially was viewed as bearish, and it was because of that flash carryout number was unchanged. We left it at 410 million. And how we got there was increasing production, 10 million, actually 11 million bushels, and increasing demand, 11 million bushels. We actually reduced our acres, 300,000 in the soy complex. We also increased our demand about 3.3 bushels an acre. All said and done, a small bump up in production, offset by an increase in exports. Trade was probably looking for a bigger demand statement to come from this report. There is a history of the USDA underestimating demand in the January report, but there was some whisper quiet numbers of closer to 350 for a carryout. So when we left that number unchanged, we automatically sold this thing off hard, as many were looking obviously for a much tighter or much smaller number. Stocks number is actually bullish, not being talked about. Some explain the little bit larger than expected stocks number as because there were so many beans in transit, may have not been counted. Anything that's in transit for both corn and beans is not counted on the snapshot stocks number. And it was obviously we did have a pile of beans going out that week, as well as what our weekly inspections showed us. But the thing that may have weighed on this thing as well is our stocks number was up 17% from last year at this time. So at this point, there isn't a concern about the tightness of the old crop carryout in beans. We also did get a NOPA crush number this week. How many beans we crushed for meal and oil this week came in a little less than expected, the same amount as last month. It was a record production month, and it may be telling us that our facilities have maxed out the amount of meal they can crush or close to it. So we are seeing meal basis soften, probably $15-25 a ton cheaper than last month at this point, and that may help to weigh on the bean prices as well. So as we move through the balance of this month and next week, everything is going to be all eyes are going to be on South America as their production season kicks into full gear. We're starting their August down there. Their Corn Belt runs more north and south versus our east and west. But rains will be of a premium over the next 3 to 4 weeks to make their crop. If everything comes through as far as the rains, you're probably looking at another record crop, or at least that's what the USDA and CONAB, Brazil's version of the USDA, has penciled in as a record crop coming out of Brazil. So those are the things that will probably weigh on the market over the next couple weeks. A little bit of a surprise this morning. We did see an announcement at 8 o'clock when the USDA comes out with their daily announcements that China did cancel 285 million metric tons of beans. A little bit of a surprise that it would show up this early. Not a surprise that they cancel them, but it is a little bit of a surprise they showed up this early. That helped weigh on beans here at the end of the week as well. Technically, the charts look heavy for both corn and beans. Maybe we can find a little bit of support in here, but certainly any type of rallies need to be hedged or sold as far as producers are concerned. Taking a look at the livestock markets, cattle futures and the cash cattle are moving in opposite directions. Did all week. Cattle was down hard again this week, $5, over $5, and the futures feel very heavy. Could be some redemptions from the index fund community. Could be a little bit of rebalancing going on, but certainly we're seeing some long liquidation. Open interest was down all week. Certainly we're looking at somebody trying to get out of the cattle futures. Cash was weaker this week, only to be pulled down most likely from the weak futures contract. Cash traded 164 for the most part this week, down from that 168 to 170 last week. Interesting enough, the choice cutout this week, as far as the boxes are concerned, hit an all-time high. So certainly we're seeing two different markets here, futures and cash, and caused a lot of head scratching this week. I think the easiest way to explain it again is maybe some redemptions from the index fund community or some type of rebalancing. Taking a look at the hog market, hog futures and cash pretty much in a line, grinding sideways to lower. Not concerned about the PED virus like we were last week. Hog weights are still up, slaughter weights are still up. Numbers are up this year as well. And one thing I failed to mention about the cattle, as well as the same here for the hogs, is export numbers continue to decline, and the dollar running to 11-year highs certainly isn't helping things. So if you have any questions about these or any other markets, please feel free to give us a call here at BIS Commodities at 1-800-373-2525.